Welcome to today's event, Capital Markets Series, Public Allocations, hosted by CFA Society Chicago's Education Seminars Advisory Group. This is the first part of a four-part series. The other three events will focus on private markets, with the next event being held on October 20th. Information on upcoming events can be found on the Society's website at www.cfachicago.org. All mics for attendees will automatically be muted during the event. If you have a question for our panel, please use the Q&A feature. This event is being recorded. Today's discussion will be moderated by Lotta Moberg, CFA, an analyst on the Dynamic Allocation Strategies team at William Blair. She is responsible for global macro research and has been published in several economic journals. Joining Lotta for today's discussion are Bob Brown, CFA, Executive Vice President and Chief Investment Officer at Northern Trust, Bill Driscoll, CFA, CFP, Director of Research at Oak Family Advisors, LLC, and Michele Gambera, PhD, CFA, Co-Head of Strategic Asset Allocation Modeling at UBS Asset Management. I'll now turn it over to our moderator, Lotta Moberg.
Thank you very much, Chris Vincent, for that introduction, and welcome everybody to today's event. Thank you for the short introductions for all of us, and we have a lot of things to talk about today, so I will not repeat those introductions. You do have the bios of our speakers on the event page, so check that out. We have obviously a distinguished panel today, and I'm really looking forward to our conversation here. So I want to start with a very big question that really set the stage here for when we're thinking about the outlook here going forward as a result of COVID. And I'll start asking Bill, but I hope all of you can chime in on this one. What have really been the main contributors here to the changes in your longer term outlook as a result of COVID?
Well, when I think about it, I was a little surprised at how quick the response was by the Fed. And it made me start to think about, one, whether there was something else that they're really worried about as far as just the overall health of the economy, whether it's just too much leverage in different pockets, whether it's student loans or commercial. They just seemed to, they needed to rush in a huge way. And I understand that the markets are falling, but I started to question just how weak the economy could be underlying, like what's more on the front page. It looks good, but is there something underneath that we have to think about? And with COVID, what happened with such a flood of capital coming in from the Federal Reserve, I just started to think that we are going to have low rates for a very long time, because servicing this debt is just going to become insurmountable over time. So
that would suggest that a bleaker outlook in terms of growth and
over the long term, yes, a bleaker outlook, and just making it very difficult to ever increase rates again.
Would you have a similar response, Bob?
Yes, I mean, in general, I think COVID-19 either accelerated and or strengthened trends that were already in place from a macroeconomic perspective. There are some obviously important differences, and Bill highlighted one of them, not just the massive monetary accommodation that we had expected, but it will certainly continue. That is, we expected even beforehand. We were always in the lower for longer camp. But every year when we update our long-term capital market assumption themes, there are 6 of them, and 3 of them always focus on the economic variables of growth, monetary policy, and inflation. And we're also in the low growth camp. We were in the low growth camp before COVID-19. We think after this bout of fiscal stimulus runs through the system, we'll be back to more or less a 2% growth environment in the US for the next 5 years. So we're not forecasting a recession. We think the economy will be supported by lower rates, and we'll see what happens with the US presidential election, and if that really creates massive fiscal stimulus on an ongoing basis. And will the government be able to really shift long-term demand curves to offset the demographic trends of a declining workforce and the struggle to get productivity above 1.5%. But the interesting thing from our perspective, we have been in the low inflation camp. We call it stagflation. And we'll see whether or not, as we say, stagflation will be tested over the next year or so, in part because of COVID-19, because COVID-19 will give governments around the world, but here in the US in particular, a unique opportunity, a mandate to really turn the spigot full force. And if that doesn't cause inflation, then probably nothing will. And so, I often joke that as long as the Swiss 10-year is trading at minus 35 to 50 basis points, I'm not going to worry about global inflation. But we'll see if I'm still able to see that 10-year rate 18 months from now.
The risk of increased inflation is out there, but still a small one.
Yeah, I wouldn't pay up for it. That's for sure. That's the type of thing you want to see the whites of the eyes before I think you start shooting at the inflation bugbear.
Maybe also from the monetary point of view, I think for us, one of the most interesting decisions that we made recently was to lower the equilibrium real rate of cash. This was requested, of course, by model governance because the LIBOR is going away and we were using LIBOR, so we have to remove it in the first place. But then secondly, also because we look at the data, and while all these statistical procedures that come, from, for example, from the Fed, like Laubach and Williams, are econometrics procedures of a reduced form, so of a very difficult to control set of parameters that are not identified, that are not necessarily stable. So Laubach and Williams comes with continuously different estimates, also based on which kind of sample you use for the real equilibrium rate, the R star of cash. And that's really key in terms of discounting models. You need to have a projection of where cash is going towards if you are using some sort of Gordon model or to discount future returns or things like that. Now, we had to shave it because, frankly, since 2008, we haven't seen really cash go much above zero in real terms. So there is no point for us to project that cash will be in equilibrium 1.5 if we see that in 10 years we are lucky if we are at 70 basis points. So I think that was one of the most material decisions that we made from the modeling point of view. And I think that the colleagues, the fellow charter holders who use this kind of discounting models should review their assumptions from this point of view.
So it sounds on you, but all of you, I think that you did have a higher path of the cash rate before COVID. Even though we were already then, I mean, if we'd had conversation at that time, right, we would have been saying, oh, interest rates are much lower going forward than I would have thought a couple of years ago.
I think we thought of that because we were saying, well, sooner or later a recession will have to come, so rates are going to go back to zero. But I think that it dawned on us that it's a 2% real is not coming anytime soon, and I'm talking 10 years for sure.
Right. So, Bob, I'll start asking you this next question that I have. This was a shock. Is there any way that we could have hedged against a pandemic shock like this one?
Well, I know one of the questions we all get is a 60-40 portfolio dead. What's the purpose of long duration bonds now? Do they really provide balance when the starting point in yield is so low and the opportunity for at least capital appreciation is fairly insignificant? that was not the case. So at least with the bet back in mid-February. And so I think with the benefit of hindsight, clearly a balanced portfolio worked. You got exactly what you wanted and needed out of high quality, long duration bonds when the world started to fall apart. But on a forward-looking basis, that's clearly less true. We still think there is a role for long-duration, high-quality bonds. You still get the principal preservation in times of stress. You still get some de minimis income. What you won't get is a large upside potential from a further decline in rates. Even if they go negative, you're not looking at 25, 30-point opportunities on long-duration bonds that you might have in years past over the full cycle of a peak to trough in a recession. But you still are able to protect a real significant portion of your portfolio, which allows investors the opportunity to rebalance and buy your risk assets more cheaply without taking losses elsewhere. And I think that's a significant attribute of high quality, low duration bonds. Now, for investors who are more tactical and who have sophisticated advisors working with them, I still think volatility is an asset class that could potentially be traded. It was always interesting to me, let alone maybe shocking now with the benefit of hindsight, that you could have bought the VIX in the low teens in mid-February when the pandemic was already front page news everywhere in Asia. It was already an issue in China and Japan and South Korea. And so for a relatively short period of time, you could have bought BXX like in the low teens and a month later had a 5-bagger. Now that's a hedge. And I still think there's going to be periodic opportunities. If you have a view on what normalized volatility will be, you feel comfortable trading it, you're buying protection around potential events. And it's been much talked about how the VIX is pricing in a little bit of it's been taken out, pricing in this election risk in the U.S. But I think there's still going to be plenty of opportunities to complement a traditional 60-40 portfolio with opportunities in trading volatility for certain portfolios.
And I would agree that the 60-40 portfolio is not dead. There are, however, difficulties here, and difficulties, I was looking this morning at a report from Barclays. In terms of investment grade, the transaction costs are elevated still. So while the credit spreads have shrunk since the March, April, when the panic started in the markets, the transaction costs are taken away for a round trip of buying a credit bond and selling it within, say, a year, 1%, 100 basis points of the spread. Considering that the spread is around 150, it is not a particularly attractive proposition. But at the same time, seeing all these things in a concept of diversification, it certainly can fit. And one thing I just wanted to add regarding the VIX is that it's certainly helpful. We want to also consider that you don't buy the spot. You have to buy futures, and usually the curve tends to go steep. So you don't necessarily buy it for a really fire sale all the time. But I think all these things can be effective components indeed. I agree with Bob.
Yeah, and if I could just add into that, we were rather conservatively allocated going into it, and I would have to say it wasn't really because of COVID. It was just because of, from a bottom-up perspective, we didn't find a lot of value in equities at the time. So we had started to move to a more conservative allocation. I just feel like when it actually started to fall apart, I was surprised that some of what was supposed to be very conservative, passive ETFs, how quickly they fell apart. And like things that had before had max drawdowns in the 5% range at max went down 15, 20%. And so you can see why the Fed stepped in the way they did, because you had this disconnect of passive vehicles that traded very liquidly, but with underlyings that did not. And that when they broke down, a lot of portfolios, even if we were conservatively allocated in those portfolios, we were seeing big hits because things that we thought were almost cash good, no leverage, just like very short maturity, fixed income, just got hammered as everyone went to cash at once. So it's just, and in a way to actually hedge it, unless you were actually in the right vehicle and the ability to either short the market or have options in there, it was almost impossible to completely hedge it unless you had a huge fixed position. I was definitely not smart enough to, go into the stay-at-home plays at that, like before it all happened. So, but it was a pretty remarkable time, just looking back. That what seems like years ago, but what was really just early in 2020.
It seems so obvious in hindsight, doesn't it?
Oh, of course.
I want to encourage everybody to note that there is a Q&A portion here. We'll get to questions in the end, but you'll see Q&A at the bottom of your screen as a participant. So you can submit your questions there. You can also vote on the questions there to, if you kind of upvote them, those questions that you like, even if you don't have a question yourself, will have a higher probability of being asked in the end. Now, it was mentioned here volatility, and we have an interesting, and thinking about the futures here in the volatility space, interesting event coming up, election year. Everything has to happen at once. What's your view? I'll throw it out there to anyone who wants to take this one on the volatility here. Are people still underestimating the possibilities here, swings?
I think the biggest tail event could be a contested election. That would be probably the worst case scenario. And there is a possibility for it. I don't think it can be ruled out. It would be, I don't think it would be in the interest of the country. But that's just, I'm not a native, so maybe I'm wrong.
Yeah, and along those same lines, I think if we go in election night and Biden's in the lead, I think it actually probably would be a good thing for the market, just because the number of people that will be sending mail-in ballots tend to lean heavily Democratic. So the likelihood of a contested election will be lower. But I think the worst case scenario is a big lead of Donald Trump on election night, and then slowly seeing that fade away as the ballots come in through the mail. Then I think that's kind of the worst case, most dragged out uncertainty situation. And that's really what I'm really hoping doesn't play out, that we have a month of just trickling in of the final counts. But
yeah, I mean, there's clearly so many unknowns. I'm somewhat surprised that volatility is not pricing in a bit more, what I think a reasonable probability, very high impact event. So it could be a contested election. It could be a Democratic sweep with a major change in the legislative platform. It could be a surprising Trump victory, and then it's 4 years of President Trump unleashed. So any of those things, I think, would justify a little bit more of a risk premium price in the market. And then President Biden elect could contract the virus before his inauguration and become sick or incapacitated. And you could game these things out, and say, well, anything can go wrong, but that's not actually a low probability event. Once he's elected, he's going to have to be. He won't be able to be hiding out in his basement anymore. He's going to have to be. Have to be interacting with people. And I think there's at least probably a 25% probability he also gets COVID-19 between now and mid-January. And then what happens longer term? What are the implications, not just for the U.S. but the rest of the world, because of this major change in leadership or continuation of President Trump, which seems less likely, but for all the reasons would be that much more of a surprise. But I don't think any of that actually changes our long-term view that inflation remains low, rates remain low, and economic growth is about 2% a year in the U.S. So what you may have are more exogenous events that affect the pathway, but the pathway, I think, for us is pretty comfortably a low rate, positive but low growth environment.
I wanted to ask about growth, and I can start with you then, Bob. in terms of the 2% that you're talking about, has COVID contributed to lowering your growth outlook? And does that matter in terms of your market expectation, the kind of the GDP component to that? How does that feed into that?
Yeah, we do have this theme that because of COVID-19, there is a greater emphasis in the private sector, and probably the public sector as well, more on resiliency and stability and less so on growth and profitability. And as companies spend more to ensure resiliency, it doesn't always lead to productive growth. And that will eventually fade away, but my guess is we're going to see that in the public sector even more so. And the short-term impact of COVID-19 is you have to figure out what's your starting point for your forecasting, just from a modeling perspective. There's so much noise in 2021 because of the stimulus and what might happen with the next round of stimulus. So we're really looking at it on a normalized basis over 5 years. And so after you wash out the impact of the trough of COVID-19, the big impact, and then the stimulus that helped accelerate, and the massive hiring that's been taking place in the private sector. But from 2021, January 1st, we're back to a 2% environment. Now, the big risk to that view is that we get the Democratic sweep, and the agenda that seems to be first and foremost in Nancy Pelosi's mind becomes not a one-off, but a series of multi-trillion-dollar expenditure programs. And then in the short run, that will clearly drive growth higher. In the long run, highly indebted developed countries with high deficits tend to have low growth. It's at least highly correlated, if not a cause and effect. So, my guess is this high debt will inevitably be a drag on long-term growth as well.
Looking at the models again, just to talk slightly about a different topic. Per se, if you think about a long-term discounting model, the fact that for 1 year, things are going really upside down, when you're computing the present value of a perpetuity, it won't have a big effect. So the fact that there might be abysmal growth in the first year or two, and then things will go back to normal, at the end of the day, when you compute the present value of future cash flows, it's not really particularly different. The question is whether the situation is in this history of humanity, we have not had persistent viral epidemics, even in periods of time where hygiene, public hygiene in particular, wasn't that great, that lasted for years. Pestilences also, there is interesting stories about the 1600s, the 1400s in Europe. Big chunks of the population died, but at the end, the thing ran away. So, based on past observations, we certainly can hope that within the end of next year, this situation will be sorted out. But what we need to think of is how much capital, human and physical capital, will be impaired between here and there. How many people not having a job, not getting used, not being any longer used to getting up at 6:30 in the morning to go and work, and things like that will lose human capital. And how much knowledge that is in different firms, in restaurants, in any sort of service organization in particular, will be lost because people can't find a job, and so maybe they go somewhere else. This kind of impairment might affect productivity over the long term, and so might lead us to also change the risk premia that we use to discount future cash flows, and also permanently change the growth rates that we have for future cash flow. So I think that is really the biggest concern as a financial analyst and as a modeler, because we don't know how long it is going to be bad and how much in terms of human and physical capital is going to be destroyed. So that's the difference between the normal, between an earthquake that destroys a lot of physical and human capital and a different kind of event, just a simple recession where yes, the economy is slowing down, but no physical or human capital is destroyed.
Yeah, I mean, Michaela brings up some very interesting points there as far as like what should be looked at in the short term and what could cause, you know, longer term damage. It's much like a heart attack. You know, at the time you can recover, but there's permanent damage done to the heart. And we're seeing some of that right now as this pandemic drags out and we're not sure how long it lasts. It's starting to make us question certain asset classes. And I'm thinking particularly in commercial real estate, whether it's retail or office space. These are asset classes which have a lot of debt against them. And as people start to question, like, I feel maybe I'm biased because I'm in Chicago and I walk around and it's a ghost town and it doesn't feel like this is anything close to a recovery here. Maybe I should get out to other towns and see, see how busy it is there. But right now I feel like, how can we survive if we continue to have, you know, beautiful buildings all around me that are, no one's in them, no one's there. These are heavily levered properties. How do we, as a society, handle that debt as, you know, people come and roll off lease? Will we be coming back to work in normal? These are the questions that I have that, like, we're not really built to be able to maintain, you know, what we had as leverage when the cash flows start to dry up. And those are the things that I worry about as far as a hangover when it comes to COVID.
Reading broker reports and such analysis early on, it seemed like the conclusion was very opposite to what Michaela was talking about, and it'll be interesting, maybe Bill has also a view on this, which was very much that the 2008 recession, and that was a financial crisis, so that was worse, and this is only a real crisis or like real business cycle, something that you can somehow bounce back from quicker, and therefore this is like a better situation. I struggled with that narrative. It's interesting to hear what your thoughts are.
Well, let me respond to myself first then, and say that from the point of view of economics, and so thinking about Reinhard and Rogoff, they showed that empirically that whenever there was a financial crisis, the effect was more longer lasting than other types of recession. So from that point of view, yes. However, we don't have a lot of observations in the last 150 years about recessions caused by pandemics. The so-called Spanish flu was mixed with the Russian Revolution, the First World War, so it's really difficult to identify what caused what.
So I'll hand that over, see if you want to say anything more about that, Bill, but I also want to ask you, when it comes to it, the reason why I feel it's important to talk about the GDP and the growth aspect is so many people are questioning now, is there any connection between growth and the market anymore? Because you look at a surging market that we've had for a long time, it's been a bit wobbly lately, but it's still at pretty high levels that you wouldn't have predicted, I wouldn't have predicted in the beginning of this if I still think that we'll be in the economic situation we're at right now. So, so I'll throw this on Bill, like, have your views on that connection changed in any way? Is there, how do we think about economic real growth versus the market and the connection?
Yeah, well, when it comes to the market these days, I think it's just, when you're dealing with interest rates where they are, and you've got an asset class like fixed income that gives you very little return relative to the risk that you have, that money's trying to find a place to be. It's finding its way into the stock market. We know we're going to probably print a very nice GDP number for third quarter. Whether it's a dead cat bounce or not from like, as we just kind of fill in for all the growth that we missed in the second quarter, we'll still see. But I think when we have interest rates this low, you have a a disconnect between the prices of stocks and the cash flows underneath. I mean, valuations have blown out, and you start to question whether the money supply growing and everything else is going to give us inflation. And with that, you start to then look around and say, well, if there's going to be inflation in the future, I better have growth to bail me out. And so people are finding and moving into those growth names because they feel that that's the only thing that will save them in a higher inflation environment. And so I think it's gotten a lot of people on board because a lot of times it's easier to, buy a name like, like Apple and Microsoft and those types of names that you can recognize, and you buy them, they have great fundamentals, and you don't really think about kind of the science behind the valuations anymore. Those are two of the cheaper, better names. But like, if I went into some of the other, whether it's Shopify or some of these names that are trading at multiples of growth that are so much higher than what I saw during the tech bubble, I get worried that we are just disconnected, not only from the underlying fundamentals, but just that this is just a lot of money trying to chase very few ideas. And what we are looking at right now is the massive money pool that was in fixed income finding its way into the equity markets. So.
Bob, you might have something to say about that. And I was going to throw on top of that a question for you. There's been a lot of talk about the market being driven up by options contracts and in that space. So it'd be interesting to hear if you have insights on that too.
Yeah, I've seen that. There's been no shortage of analysis. I just don't think that's a sustainable reason for the markets to continue to go up and stay at elevated levels. At any point in time, it's either that or the momentum players. There's always somebody in the short term that can be that marginal source of dollars for the marketplace, especially in thin markets that can explain a disproportionate share of performance in the short term. But in the long term, as has been noted, it basically comes down to cash flows. It's real distributed cash flows. That's what creates value. And so on the point about whether or not there's a disconnect between real economic growth and earnings growth, up until this year, where much of the return has been obviously driven by PE expansion, the fact is there's been good solid earnings growth on these so-called growth companies, and a lot of it's been idiosyncratic, specific to a handful of the growth companies that have formidable business models and really are benefiting from the discounting of those cash flows in a low rate environment. And so if you're an Apple with a really loyal customer base in this unique ecosystem, or a Microsoft that has successfully moved to a subscription-based fee model, whether it's cloud, Office 365, Xbox monthly fees, and you can scale that across the globe. Yeah, I mean, why not pay 35 times earnings for that when the 10-year is trading at 75? If you think it's sustainable for a reasonable period of time. Now, the mistake that investors will make is that every company is going to become the next Microsoft, and that doesn't happen. Shopify probably will not become the next Amazon, and at some point, the competition comes in from one of the dominant players, or you get innovated out by a new entrant, and to assume that good story for every stock is usually a bad assumption. But to assume it will happen to no one is an equally bad assumption. And the reason we do what we do is to try to separate the former from the latter.
So Michele, I'll ask you a monetary policy question. We talked about low rates. That has changed the game here a lot, but it just seems like the central banks have done a lot. Are they out of bullets soon? Could it be, you hear more and more calls now from central banks saying, hey, fiscal policy should do more. Are they kind of just waiting for, and will they soon hand lower to fiscal policies? That's where we're going to get stimulus from going forward? What's your thought about that?
I think that the austerity views that have been really important part of the political messages around the world over the last 30 years have led to a really narrowing of the function of fiscal policy. And despite the austerity, despite the narrowing of fiscal policy, almost no country except for Germany and a few others have been able to balance their government budget. So one wonders if austerity is like marijuana prohibition. It is a very sensible suggestion. I never tried weed in my life, but I am against prohibition of weed because I think it's stupid. I like grappa. I'm Northern Italian, so that's how we roll. And you know, okay, as long as you're not driving with grappa in your body, you're fine. That's my view. People need to be responsible and to be held responsible. So also, these things, for every difficult problem, there is a simple solution that is wrong. And I think austerity was a wrong solution. It led to really an abuse. And central banks have been certainly quite creative in trying to help out the economy. And now we are getting to a very strange situation where central banks are the majority bondholders for a lot of governments. So since the central bank is a part of the government, per se, it would not be too ridiculous to say that the government lending money to the government is kind of, why don't we just rip these pieces of paper up and forget about the whole thing. So I think that might be actually, even if I am no fan of MMT or magic monetary theory, like a friend of mine says, we are at this point with government bonds that return almost nothing, if not negative in Europe and in other areas. I think people in Europe would be better off by having more cash rather than government bonds that have a negative rate. So print more cash and get rid of these bonds that are held by the central banks. So I think that would be probably the last chance if fiscal policy is not able to push inflation a little up, because we need a little bit of inflation to lubricate the economy. All the textbooks used to say, we don't need 5% inflation, but 2% inflation seems to be a reasonable thing to allow for relative price adjustment within an economy. So at the end of the day, I think that central banks may have more bullets. They certainly have some weapons, but some of these weapons will be really untested. And I think that this would be a good reason why fiscal policy should probably continue to be active as it's been in these emergency months.
I would think that governments will be really happy if they can spend and spend without getting inflation. We do live in a semi-empty world, it seems, in the sense of modern monetary theory, that stands for everyone, where people are saying with rates this low, you can basically spend and borrow more money. Is there any place, and I can throw this to you, but anyone can of course respond to this in the previous question, is there a limit here? At some point, does increased debt levels actually become a constraint to the government spending, or can they really go on forever?
It certainly is not a good optic. It doesn't look good. However, also I think one concern for me is where the money is spent. Is it in salaries or is it in infrastructure? Because, you know, anybody who is against infrastructure, please take a drive down Lakeshore Drive and get back to me.
All right. Let's see if anybody wants to comment on anything of that. Otherwise, I'll move on. Okay, Bill, I'll ask you a question here. We're pointing out things that maybe people have heard before, right? It's a low rate environment, low growth. Okay, so many things seems to have changed here, and I'm hoping if you could help us put this together. So we have zero rates in so many places. How should investors, should we like rethink what we knew about markets? correlations. We have assumption about correlations that rely on historical patterns. We rely on, in our models, on US dollar dominating the world. That could be another force for change. In this whole concept of, in the context of so many things have changed, how do we rethink things? Should we think completely different? Are we kind of stuck in our pattern of thinking here? And if we're thinking about clients' wealth here in this world, how do we actually maybe protect it is the more relevant question rather than grow.
Well, I think the one thing that I get most concerned with how to protect my client's growth and just preserve his capital is when I think about, my allocations and equity and fixed income and everything else, we're always transacting in dollars. And so I'm always worried about, like, we have been in a dollar strong regime for 40, 50 years here. Will that paradigm, be upset? At some point, will the dollar as the reserve currency of the world, be questioned? And when you talk to people from outside of the country or listen to podcasts or whatever else from people that are not US citizens, we look like kind of a mess. The country, whether it's you just looking at the social unrest or, two, elderly presidential candidates screaming at each other on TV, it has to erode confidence in the US dollar. And as China has become a greater and greater power, and everyone starts to question, whether U.S. as the lead economic power in the world should sustain, I think you have to worry about whether we're playing a game of like maximizing our dollars, but whether the dollar itself is what we really have to worry about. That we've done well in dollars, but across the globe, if we lose reserve currency status, we've really lost our position of wealth if we do not protect ourselves or diversify our currency risk. And so in a lot of ways, when I think about that, I want to own companies that have revenue and costs that are diversified from a currency basis. So some of these larger companies that are more fiscally sound than governments are. So I think that's part of the reason why you maybe have seen some of these mega cap companies like doing as well as they are. Because they should be able to sustain themselves, no matter whether the dollar is strong or not. I mean, they are, truly behemoths in the globe. And then, so that's one part of it where I think about like the currency itself and do we need to diversify our currency risks. Secondarily, like just when I think about my allocations within just the domestic markets, where I'm not earning anything or my buying power for my fixed income is eroded, where I'm basically losing money if I look at my real returns for fixed income, do I have to start thinking about owning more equity income and changing that 60-40 portfolio to look more like a barbell approach, where I have things that are equity risk but better returning, but I'm balancing them out with very strong capital preservation, even if it's just short-term treasuries or inflation-protected securities, those types of things that I think will be dollar good at the end of the day. So those are the things that I've been thinking about when it comes to an allocation.
Yeah, we mentioned the 60-40 before. You hear about the death of the 60-40, and the question then becomes, what is the alternative? And alternative assets that go into there, and I can see with Bob and Michaela to have views on what's the alternative asset that might be interesting here, and what's your outlook for these? Do you have anything juicy for us? So we have commodities, oil and gold. Do they go in there soon? We have cryptocurrencies. People start thinking about that too as being part of this kind of barbell strategy that Bill mentioned. What's your thought about that space?
Well, we certainly look at that for accredited investors. Alternative, both PE and hedge funds are a strategic allocation. And so they belong in the portfolio. They help the diversification. They give clients access to parts of the market they can't get via the public markets. And the composition of the private equity market is really quite different from the S&P 500. And so take advantage of that. For us, things like gold, commodities more broadly, other than equity-based commodities, but gold, that's an opportunistic asset class. It's not a strategic asset class for us. I do just want to circle back to your earlier question, though, about what, this is in particular for the viewers who are earlier in their career, about the issue of, should we do a gut check on some of our assumptions? Do the models work? And I would just encourage everybody to be skeptical, to be cynical, to be humble. We're all overeducated relative to what we're doing. This industry has become even more quantitative through my career. I started off doing derivatives when I was a so-called quant, and I'm nowhere near the talent that's available on this call, let alone in the marketplace. But there's no shortage of at least mistakes, at least in timing, if nothing else, that we've all made about value outperforming growth. That's been a long period of underperformance. Rates can't go negative. And so, be thoughtful about the framework you use. What's foundational, what's core, and what needs to evolve, and what you need to be flexible on. And what do you know for sure, and what you don't know? When this active / scientific approach you take, just remember, economics is a social science. People who get Nobel Prizes, their papers would never even be published in a physical journal. If it was like physics or math, it's so there's a very different criteria of academic threshold in the social sciences than in the physical sciences. So like just one example of what I think about, what do I know for sure? The Federal Reserve is not going to raise interest rates over the next 5 years. That's a big foundational belief. And that can drive a lot of your asset allocation framework. And there's a whole bunch of things I don't know, or that I don't have the same degree of confidence in. So really spend a lot of time thinking about what I know, what I don't know. Where is my assumption really creating a lot of contingent risk? That this has to happen, and then if that happens, this happens. And if that happens, then I make a lot of money. The more dominoes that need to fall before you make a lot of money, I'd be a little thoughtful about overcomplicating your investment process.
Those are the kind of questions that I'm sure our audience were thinking that they get answers to today.
I think if your plan is to make a lot of money, you are in the wrong business. Maybe move to San Jose and start a company. Maybe there you can make a lot of money. But with the 10-year bonds giving you 75 basis points, with equities that are either expensive in the US or inexpensive outside the US, but inexpensive for valid reasons. I don't see any free money. Certainly in the alternative asset classes, there may be things that can help out the larger portfolios that can afford to buy these things and to keep money illiquid. I'm thinking, for example, direct property as a somewhat perhaps substitute for bonds, because bonds don't return very much. But property right now is going through an incredible change, because clearly, if you look at the weights, for example, of the NCRIF index, which is in the level 1 curriculum to discuss the problem of smoothed earnings. I remember it even after almost 20 years. The NCRIF index has a pretty massive weight on shopping malls and office buildings. And nowadays, I think I heard that our plan might be for some of our offices to have fewer desks than employees, assuming that in the future, not everybody is going to show up at the office every day, and therefore the desks are not assigned, and there are fewer desks than employees. So if that is the case, I think that the asset class of property will have to change substantially, increasing the apartments, increasing the medical and whatnot. and decreasing the exposure to shopping malls where, you know, JCPenney and Sears stores right now are being used by immediate care physician kind of places, because so it's really changing materially. You can't just buy anything and think you're not gonna make a killing.
Yeah. So if we get fewer people chasing money, maybe we have higher quality people in finance. I should move on to questions very soon. I have one more I want to just throw at Bill that I'm wondering about value versus growth here. The outperformance of growth that we've seen. Does that mean anything? If you know how these factors are constructed, it's a kind of like you can interpret it in many ways. It's not that simple what it actually means. What's your view on that?
Yeah, I think I touched on it a little bit before when I think it's in some ways people are thinking about if inflation does pop up, you need to have growth to get there. So I did a little bit of a math lesson on my own. Pulled out the Excel spreadsheet, looked at different growth rates at different discount levels, and said, what would I pay, you know, for 5 years of good growth, 10 years of good growth? If I discounted back that future earnings, you know, what's the appropriate multiple of $1 of earnings? And kind of played all the number games just to see, you know, what that delta was of how much more you would pay for growth, and what happens to the equity valuations if you own a 5% grower or 3 to 5% grower and inflation ends up 3 to 5%. You quickly see, you know, the erosion of your principal in those environments as far as, you know, just the way the math works. Whereas if you have growth and inflation's around, you can bail yourself out. But the thing is, it's just when you look across the landscape, and this is part of the reason why I think value and growth has such a disconnect right now, it's a lot of these value names with that lower growth won't do well in a low inflation environment. You know, they won't have the ability to, you know, see your equity have appreciation because it just starts to erode, you know, as inflation picks up. And to truly have capital appreciation, you need to have that growth in excess of inflation. And there's very few companies that are actually doing that out there. It's just that right now, the premium that you're paying for those companies that have good growth and potentially good duration of growth, I just never seen it quite as high as it's ever. You know, I've never seen it this high before. Whether it was, you know, at R&B Capital or Zuckerman, we always ran kind of a wish list, a best ideas list of companies that we felt were the most moody and the ones that we always would want to buy at the right price. And I've maintained that list over the, you know, last 15 years of my career. Started really leaning towards those types of names as like true compounders, best way to grow wealth over time. And I'm looking at the valuations within my kind of wish list, and it's just like I sit there with my mouth open, just like I can't believe what we're paying now for those companies. And if they don't deliver on that growth, you know, you have some risk of multiples compressing over time. But I think that's what it is. I think at this point, it's a haves versus have-not market. There's a lot of money chasing. I think people are pretty good at identifying the best business models. And right now, valuation doesn't seem to matter, so you just own the best business model. If you've had anything within your, and it's always somewhat, you know, money flows. If anything within your style is valuation based, you've probably lost to the indexes. And so you're seeing money flow out of your products. And I think that also has helped compound the value versus growth. And that doesn't really break down, in my opinion, until, you know, the risk-free rate starts to get a little higher, and we don't see that. So until interest rates start to move, I think value continues, you know, to have a tough time versus growth. But at some point, you can't keep pushing growth higher for the same reasons each time. But that's the way I'm viewing it, at least.
All right, with that, I'll throw a few questions that come in, picking the good ones here. One is about the pension crisis, and I don't know who would like to take this, so feel free to just jump on this, whomever wants to go first. What can Illinois or the US do to help with the pension crisis in Illinois and other municipalities? without any federal aid, what will happen to the retirement system?
But the math is not really attractive. Bob, why don't you go ahead?
Please go ahead. No, you go first and then I'll follow up.
I'm just saying that the math is not very attractive. There is no expectation that there is any magic asset class or any magic asset allocation sleight of hand that will transform a 20% funded plan into a well-funded plan. And on top of everything, I think that there are the constraints by the Constitution of Illinois. I think probably there will be a need for a constitutional reform so that there will be a solidarity in which taxpayers pay some and retirees give something up so that there will be funding for the future. I guess that's the only the way I see it. Bob, what do you?
Yeah, well, I think for states like Illinois, there's two potential paths, and the question phrased it the right way, with or without federal aid, is that dependency is really important. But without federal aid, it's as implied, the math just gets in the way. It's going to be a little bit of everything. The pensioners are going to have to give up certain rights that they already have in terms of future payments. Taxes will go up. And the risk is, of course, Illinois is already one of the few states losing population, and that accelerates. You know, the wealthy, sophisticated people are very mobile. And so you got to find that right balance where you still create a fair ecosystem for those who you want to pay taxes, both property and income, and you provide the necessary stability for those who have earned the right. I think it's a real shame. I mean, it's one thing for a 40-year-old now in the system. They have no right to expect the pension that they think they're going to get, they're actually going to get. But if you're already retired, if you spent your 35 years in the city school system, and now you're in your 60s and you're being told you may have to take a haircut, yeah, I mean, there's some real, I think, ethical issues around that type of trade-off. But stop digging the hole deeper. You've got to get the younger people out of the system, and so that they can, then they have 15, 20 years to plan. That they're not going to get that nice, attractive DB plan, be able to live off that when they retire. They can move. They can do what the private sector has done. You know, very few companies have defined benefit plans anymore in the corporate sector. You move into a hybrid system where both the employee and the company or the state pay. But I tell you, the big if here is the election. One of the stumbling blocks for the current fiscal stimulus is the amount of aid that the Democrats wanted to provide to local municipalities and states, and that wasn't directly for pensions, but it took the pressure off the pension side because you could fill the gaps elsewhere. Money ultimately is fungible, so if you give a state a lot of money for this, it makes it easier for the state on its own to pay for that. And so I would encourage people to really watch that. Ultimately, it's going to be a political situation. These are political entities. And so this is important from an analytical perspective. You may completely miss the boat if you only look at it from a financial analyst perspective. You have to put your political analyst hat on. And the solution may vary from municipality to municipality. At the state level, ultimately, that's going to require all the families to get together to figure out what the great trade-off is. But I would just watch the political situation closely, and the same thing on student loans. If you have children or you yourself have student debt, I would not pay it off early. I would wait, because I think there's a high probability that a lot of that student debt is going to be forgiven in the next administration. So don't pay off your debt early. That's hopefully the most important takeaway you get from this webinar.
I mean, there are a lot of open secrets out there by now, right? That Social Security is a tax. It's not a way for you to save for the future. And what you thought was debt, on the other hand, is not really debt. So yeah, I'll finish up with one quick question that came through. It's kind of connected to what we're talking about with the value growth. And when we're thinking about the growthy tech sector here, the question is what valuation multiple is too high for big tech? And it's interesting in the sense that, just to frame it, that we can understand why tech has done so well, but where do we go from here? You know, like if valuations can go higher, you shouldn't rely on any mean reversion here. So any thoughts on that before we wrap up would be cool.
Yeah, I mean, when it comes to big tech, I mean, obviously, if we're looking at Microsoft or Apple and, you know, Amazon, if we put Amazon into big tech, even though I know it's, you know, in a different sector now, I've always looked back and said, you know, how are these business models different? I will always pay more from an enterprise value to sales basis for a high gross margin business like Microsoft. I've always looked at Apple, even though I understand how sticky it is. I think I'm the only Android holdout in my household. I think everyone else in my household, all 3 teens and my wife, are Apple people, and they'll probably be for life. And you see, Michaela too. I mean, and so it's as long as they can keep tricking people like Michaela to spend $1,000 per phone, you know, you're going to, you know, have a great business model. But like at 30, 40% gross margins, I would never pay what that company's trading at right now.
It's an Android.
That's an Android? Oh,
it's an Android, yeah.
Very good man. So when I think about big tech, you're paying for the balance sheets. You're paying for some of what I was talking about earlier, as far as like these things are healthier than governments. That's all in there. But I look always at it stock by stock. I know they all trade together, but when it comes down to it, I think Amazon's got a very insurmountable moat. You know, their ability to kind of be more of a tech company and just take little bits of each transaction. Maybe they're getting a little bit too much of a multiple for AWS as far as being, you know, the driver of their growth. But Microsoft I find attractive. Apple I wouldn't touch. And then like when it comes to like the Netflix, I just think that business model will be challenged, even though it's a, you know, a good company. I just think it's got a more competitive space to deal with. So I look at it stock by stock. I can't wrap them all up and say big tech should be trading here. I always pay more for higher gross margins, though.
Thank you. Any final thoughts?
Well, I do think Bill's making an important distinction. For a fundamental portfolio manager who's focused on individual stock opportunities, and you do your homework and you have your own assumptions, yeah, there will be companies that justify at 30 times PE. But from a portfolio allocation perspective, to assume an entire sector justifies 30 PE, that's when you start, you know, really pressing the envelope. So, because as I say, most companies don't become an Apple or a Microsoft. Even Microsoft was not a Microsoft for over a decade. It was dead money for a long time before it had its resurgence, and Apple had its resurgence. Most companies don't come back like that. They just disappear. And so, but if you're a portfolio allocator, valuation is always going to be important. And if you're a concentrated stock picker, then as Bill said, you know, there's always going to be that story that can be justified and turns out to make a lot of money. But to get 100 of those stories, that's a really bold assumption.
Okay, with that, our time is up. I'll excuse us very much for any unfortunate product placement during the session. And I want to really thank you, Bob, Bill, Michele, for sharing your insights with us today. Thank you everyone who joined us today. If you have any questions about this event or any other of our events, just email CFA Chicago office at info@cfachicago.org. And with that, thank you all very much and have a nice evening.
Thank you.